All right, let's get right into it. Welcome to today's Explainer, where we're tackling a massive, incredibly relevant thought experiment. We are living through an unprecedented boom in artificial intelligence right now, with literally billions flowing into the sector. But what if things don't go exactly as planned? Today, we're mapping out the blast radius of a hypothetical market correction, where the current AI boom simply doesn't meet the sky-high expectations currently priced into the market. We're going to break down exactly how this scenario would unfold step by step using the data and historical context we have at our disposal.
So here is the multi-billion-dollar question that's quietly keeping analysts up at night. What happens if the AI bubble bursts? We really need to look beyond just the tech world to understand this. If the incredible amounts of money pouring into artificial intelligence don't materialize into sustainable, real-world profits, the shockwaves aren't just going to stay isolated on Wall Street. They're going to travel straight down to Main Street. We have to explore the mechanics of this chain reaction to truly understand our financial ecosystem today.
To ground this scenario in reality, we gotta look backwards for a second. 78%, that is the staggering amount the Nasdaq dropped between 2000 and 2002 during the dot-com bust. During that same 2.5-year stretch, the S&P 500 dropped roughly 49% from peak to trough. When revolutionary technology faces a reality check, the market repricing is often violent and deeply corrective. We've seen this movie before, and while history doesn't always repeat itself perfectly, it certainly rhymes.
To understand our current situation, we need to define the very foundation of this boom: AI capex spending. We're talking about capital expenditures, the hundreds of billions of dollars being poured right now into building massive data centers, buying specialized microchips, and securing the insane power infrastructure required to run it all. Why does this matter to you? Well, because right now, this specific spending is propping up a huge share of the overall earnings growth in the entire S&P 500. It's literally the engine pulling the current market train.
Section 1. Wall Street's Reckoning.
Okay, so if AI monetization disappoints relative to the billions invested, Wall Street is going to be ground zero. But listen, you can't just overlay the year 2000 onto today. During the dot-com bubble, companies had eyeballs, sure, but absolutely no earnings. Today's AI leaders, on the other hand, they are generating massive real earnings and free cash flow. Because of that fundamental strength, a crash today might see a sharper initial fall, but the bottom could actually form significantly faster. The underlying businesses are undeniably real.
But make no mistake, the consequences on Wall Street would still be severe. Because the broader index has become overwhelmingly concentrated in just a handful of mega-cap tech names, if those giants stumble, a 40 to 50% decline for the S&P 500 isn't unthinkable. Index funds, which are dominated by these few tech giants, would suffer disproportionately. Venture capital and private equity portfolios, currently marked at highly inflated valuations, would face brutal write-downs. And the IPO markets, expect them to freeze for years, much like what we saw from 2001 to 2004.
And this is where the Wall Street pain lands directly in your living room. Everyday retirement accounts, your 401ks, your IRAs, would take a major hit due to that heavy equity exposure. This introduces a really critical danger called sequence of returns risk. Think about it. If you're near retirement and you get hit with a 40% drawdown right as you begin withdrawing funds, your portfolio might mathematically never recover. It's a terrifying prospect for those counting on these funds in the short term.
Section 2. Main Street and your family.
Wall Street never suffers in a vacuum, right? Let's walk through how this builds, step by step. Step 1. Immediate job losses. We'd see this concentrated in tech, semiconductors, and specifically the construction and energy sectors tied to building out those data centers. Step 2 triggers what economists call the reversal of the wealth effect. People see their portfolios shrink, they feel poorer, and so high earners immediately start spending less. Step 3, that lack of spending ripples outward. It cripples local restaurants, travel, retail, and eventually the local housing market soften. Geography plays a huge role here too. Tech-heavy regions are uniquely vulnerable. Look at the Bay Area, Austin, and Seattle. These housing markets are heavily propped up by tech workers. If the dual catalysts of lost jobs and evaporated stock-based compensation hit these areas, you would see localized housing markets soften incredibly fast, mostly because the highly compensated buyers just suddenly vanish from the market. And the final piece of the Main Street puzzle is credit. Remember those massive data centers we talked about? Many of those are financed with debt. If those companies face refinancing pain, it could easily trigger a broader credit crunch. When banks take losses, they pull back lending across the board.
Suddenly, the average borrower finds it much harder and way more expensive to secure a mortgage, an auto loan, or a critical small business loan. Section 3. The Average Joe's Playbook.
All right, let's get into the defensive playbook. The absolutely crucial golden rule here is this: do not panic sell. History is screaming this lesson at us, yet human nature always tries to ignore it. The people who panicked, capitulated, and sold everything at the bottom in 2002 ended up missing the entirety of the massive market recovery that followed. You lock in your losses the exact moment you hit the sell button in a panic.
Instead, if you're a younger investor with a long-time horizon, your strategy honestly shouldn't change at all. Dollar cost averaging continues. When the market drops 40%, that simply means your routine monthly contributions are buying future shares of great companies at drastically cheaper prices. A market crash for a young investor is fundamentally just a massive discount sale.
Next in the playbook, diversify beyond mega-cap tech. If your entire portfolio relies on 5 tech giants, you're highly exposed. Historically, during tech crashes, other sectors hold up much better. We're talking about value stocks, international equities, and sectors far removed from AI capex, things like utilities, healthcare, and consumer staples. Because let's face it, people still need electricity, medicine, and groceries, even when the Nasdaq is plunging.
Stepping off the brokerage screen and looking at your checking account, keeping an emergency fund of 6 or more months of living expenses becomes absolutely critical. If that ripple effect we discussed hits your specific sector and layoffs occur, this cash buffer is exactly what prevents you from having to sell off your investments at rock-bottom prices just to pay your mortgage.
You also got to relentlessly avoid concentration risk. If your 401k is overly weighted in your employer's stock and your employer is heavily tied to the AI sector, you are standing directly on the fault line. If the company takes a hit, you could lose your job and your retirement savings simultaneously. That is arguably the riskiest spot to be in during any sector-specific downturn.
In a scenario like this, boring actually becomes beautiful. Bonds and cash regain their appeal. When equities crash, there's typically a massive flight to safety by institutional investors. They go out and buy U.S. Treasuries, which pushes Treasury prices up and yields down. Having a balanced portfolio that includes bonds can really help offset those brutal equity losses and smooth out the whole ride. And finally, for those who do maintain liquidity, there's the phase of opportunistic buying. Timing the absolute bottom of a market is notoriously hard. It's basically impossible. But historically, investors who had cash on the sidelines did exceptionally well by stepping in, say 12 to 24 months into a downturn. They buy high-quality companies whose valuations were completely depressed just by the broader market panic.
Section 4. The long-term reality.
Okay, it's important to take a collective breath here. We are not talking about an apocalypse. We're talking about a reset. Remember, the dot-com bust was brutal, sure, but it did not destroy the internet. In fact, the crucible of that crash cleared out the pets.coms of the world and made way for the real giants. Amazon, Google, and the modern web emerged from the ashes. A hypothetical AI bust absolutely wouldn't kill artificial intelligence. The technology is simply too foundational for that. Ultimately, a major market correction functions as a brutal but highly efficient sorting mechanism. It strips away the euphoria and forces a hard separation between companies generating real, sustainable revenue and companies that are simply running on borrowed money and hype. It resets valuations across the board to a level that reality can actually support.
Now, I do want to make this absolutely crystal clear, right in line with what our source material explicitly states. This entire explainer is a hypothetical scenario meant for analytical discussion. It's a thought experiment. It is not a prediction, and it is for sure not financial advice. I am not a financial advisor. Every individual's risk tolerance is totally different, and you should always consult a registered advisor for decisions regarding your personal financial situation.
So we reach the end of our blast radius map, and it leaves us with this final, vital question. When the euphoria eventually fades and the market ruthlessly separates the true hardware from the empty hype, what will the real, sustainable AI future actually look like? The technology is absolutely going to change the world, but the path to get there might just be a whole lot bumpier than Wall Street wants to admit. Thanks so much for joining me on this explainer. Keep learning, stay focused, and I'll catch you on the next one.